Hello, welcome to Macro Point of View Commodity News on Tuesday, September 26, 2023. Let's take a look on the markets of gold, oil, and some other commodities. What is the current technical and fundamental or macroeconomical situation on those markets, and how the futures price might be shaped by the market. Let's go. Okay, let's start with oil, and as we can see, I predict that here after 8th of September the price will rise, and it did, and it's still above our levels. Of course, our daily chart is showing that 95 is still valid as a destination point, because it looks like the market is not planning to go higher, and the problem is on several fields here. The first thing is that we have once again commitment from Federal Reserve in the United States that inflation above 2%, which is Fed target rate, is more dangerous than rising rates and slowing down US economy. I personally disagree with that, especially that inflation doesn't cost people jobs mostly. The slowing down of total market in the whole country, especially the biggest economical power in the world, is creating more job vacancies. More jobless people, sorry, not vacancies, but jobless people. And that's a much bigger problem for me than having a bit higher inflation. Of course, I know almost 4% is almost twice what is Fed rates target rate, but yet it's still better from my point of view. Anyway, this is what they said. Also, European Central Bank claimed that they're gonna fight inflation, so this is another claim that another rising rate might be on the table. That's the problem. And now those numbers, those rates can lower demand for oil in a global way, and that's lowering demand is a risk that keeps those prices far from $100 per barrel. Of course, this is the oil Brent, because why I underline this is a Brent, because we probably all know that G7 made a price cap on Russian oil on the level of $60 per barrel to make sure they will be able to earn some money on it, and yet they don't be founded to continue the war against Ukraine. And guess what? Something happened. ESPO, so Eastern Siberia Pacific Ocean, this is a type of Russian oil, is selling with a bonus above the prices of oil Brent, not cuts, not lower prices, about $20-30 on a barrel we were seeing in August. Now they're selling higher, closer to $100 per barrel, which means, of course, that G7 decision, the price cap, isn't working at all. It's of course not a thing that will affect our Brent prices or WTI prices, yet I think it's showing that Russian oil and those that Russia is on war against Ukraine become quite normal thing for the rest of the world, and it's still sanctioning by some countries, European Union, United States, and some other countries, is less significant with the G7 price cap than oil demand by the rest of the world. Of course, it proves that Saudi Arabia and Russia cuts, Saudi Arabia on production, Russia cuts on export, is working. And it will be probably keeping the prices above $90 for the rest of the year, or until one of those countries will start losing the tight grip on oil. Until then, until maybe some kind of much further higher inflation price rising in the next couple of months, those $90 per barrel will be probably hold. And now I think, yes, we can expect some rise probably here, but we should be kept under 95. The point is, on Friday we'll have United States information about the PCE index, which is the base information for Federal Reserve about the inflation rate, and this is the key marker for the Fed, for the future prices, for the future decisions on interest rates. So I think till then we might have a bit calm, bit technical market. So technically $95 is a roof for the oil prices at the moment. And going further with the gold, as I said, we can see that 1900 is the current floor level for the gold, and well, the Fed informations about those keeping rates higher or even rising them again as long as the inflation is above 2%, which is Fed target rate. Well, that's something called burden for the gold. And let's see, the current support lines are 1900 and the lower is 1885 per ounce, so this is the levels we can expect something. Now for the very current situation, I expect that we will have small resistance here and some technical reaction of probably about $5 to $8. Somewhere between here we should have tomorrow, maybe Thursday, we should have rising on this here, on this till this area. Yeah, I know it's very small one. Please take a look that this is D1, this is daily interval, so it's $5 to $8 from the 1900. From the current level is up to $5, so it's not much, but it should be just a technical reverse, and then going probably back down to test again 1900, and then we will see how it's gonna go further. So for the gold, I don't have much. Same thing, it will be main point for the gold to see what PCE readings are on Friday morning in the United States time zone. And I cannot help myself to take a closer look on a wheat, where we have some changes on the prices, and we come back on the next contract because it's wheat second contract, it's not current, it's the next one. We are above 600. Yay, this is for me kind of good information, except the one that we don't know what will happen. El Nino is in the middle of formatting, and it's not so strong, it's not very strong, it's not very weak. It will probably help with moisture in both South and North America, which should help Argentina, which should help Canada and the United States, of course, but it will be also affecting badly Australia and Southeast Asia. Let's focus on those markets, because we know that there will be probably some another droppings on wheat production in Australia because it's too dry. We've got, as I said, very bad condition in Argentina because we had dryness in the past 2 years, and it's keep continuing. So even El Nino, if there will be keeping some rains between October and February, it might not be enough. It should be very strong rains to support it. Not too strong, not to have another effect, to have too much water in wheat fields in Argentina, but yet it should be raining heavy to make sure it's measured enough. So we're gonna take a look on this. For the next, I was asked this week about my comment for one of the magazines on the future price of wheat, and as I said, for the next 12 months I'm expecting rising those prices about 20% or more, because I think that 8.5 million tons deficit will be probably rising up to 10 millions or more, which should affect. Please also remember that since Black Sea deal was retraced from Russia, they start attacking export facilities in Ukraine. First sea export terminals, now they start, like last night, and export facilities on rivers. And Ukraine was forced to close one of the border crossing between Ukraine and Romania and redirect all the export to another locations to leave Ukraine. So Russia is fighting for their own interests, which is kind of obvious because this country is on the war, and they probably getting some success on those fields. So I think it should be also affecting the prices of wheat in a very positive way for the prices, which means going north. And for the last item for today, the current levels of cocoa is 3,500 per tons, and cocoa is supported by the supply side of the market, as there is slower deliveries to export ports in Ivory Coast and Ghana, and there is also rainy weather recently, which creates another fungus sickness for the cocoa trees. And I think it should be affecting the main crops in Western Africa of cocoa, and it should support these prices to rise again and retrace from 3,500 above $3,600. So this is my idea for cocoa, and this is the idea I will leave you on. Please do not forget to subscribe to our channel and leave a comment, like the material, or share it with your friends in social media so we can reach more people. And see you on the next Macro Point Commodity News. Thank you very much and have a good day.